Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at strategy.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, today we are jumping into something that is, frankly, just wild to watch unfold.
Oh, absolutely. It's unprecedented.
Right. Because you have this traditional software company, and they basically decided to just abandon their original, core business model.
Yeah, they effectively pivoted the entire entity.
Exactly. They pivoted to build this staggering $42 billion machine, and the whole thing is designed to do just one thing, which is endlessly buy Bitcoin.
Which sounds crazy when you just say it out loud.
It really does. I mean, whether it's financial genius or just utter madness, strategy is completely rewriting the rules of corporate finance right now.
They really are. And, it's happening during a period of intense volatility.
Yeah. Intense is an understatement. We are looking at a stock that has seen a brutal 71% drop from its all-time high of $456 back in July 2025.
Right, a massive drawdown.
But despite that, terrifying drop, they are aggressively deploying billions of dollars right this second. So our goal for today's talk is to figure out exactly how they are funding this.
Unpack the actual mechanics of it.
Yeah. The mechanics behind their capital structure, and to see if this is, the ultimate contrarian value play for your portfolio.
Well, it is a fascinating setup for investors because the traditional software revenue is still there.
Right, the legacy business.
Yeah, but it basically just acts as a stable backend to, keep the lights on and pay the basic bills.
A predictable cash flow.
Exactly. But the primary driver of shareholder value now, it is purely their ability to deploy capital into Bitcoin.
Which they are doing at a scale that is just hard to wrap your head around.
Truly. And they're doing it through some highly innovative and, I should add, highly levered financing mechanisms.
Let's actually unpack the sheer scale of those mechanisms because the numbers here are staggering.
Where do you want to start?
Let's look closely at March 2026. In that single month, Strategy purchased approximately 45,000 Bitcoin.
Just in 1 month.
1 month. They deployed roughly $1.2 billion to $1.5 billion just to make that happen.
And obviously you don't do that by just emptying out your standard corporate checking account.
Right, exactly. You don't just find $1.5 billion in the sofa cushions. They funded this primarily through what they call their stretch preferred shares, alongside, standard common stock sales.
Yeah, the stretch shares are the real key here.
And management has pointed to this forward-looking capital raise initiative of $42 billion.
Staggering number.
It is. And they plan to split it right down the middle. Half common stock, half these stretch shares. But, okay, stop right there because I need to push back on this a bit.
Sure, go for it.
These stretch shares, they offer an 11.5% annualized dividend.
They do.
I mean, if a traditional company walked into a traditional bank asking for billions of dollars at an 11.5% interest rate, they'd be laughed out of the room.
Oh, absolutely. The loan officer would show them the door.
Right. It sounds like a subprime nightmare. So how on earth are they surviving that kind of cost of capital? Aren't they just vastly overpaying to get their hands on more Bitcoin?
Well, see, it sounds incredibly expensive if you evaluate it through the lens of traditional corporate debt. But you have to look at the actual mechanical structure of the instrument itself.
Okay, break that down for me.
You can't just look at the headline yield. Yes, 11.5% is a hefty premium, but unlike a traditional bank loan, these preferred shares have absolutely no default risk covenants.
Wait, really? No default risk?
None. That is the genius of this permanent capital vehicle. Think about it. If you take out a multi-billion-dollar bank loan and the value of your underlying assets plummets...
The bank calls the loan.
Exactly. They call the loan, they seize your assets, or they force you right into bankruptcy. But with the stretch preferred shares, that default risk is completely eliminated because, technically, it's classified as equity, not debt.
Oh, wow. So there is no maturity date where a bank suddenly knocks on the door and demands their money back.
Precisely. It is perpetual. It gives the company almost limitless flexibility.
But they still have to pay that 11.5% dividend, right? How do they survive that ongoing cost?
This is where the mathematical flywheel comes into play. So the dividend is paid monthly, and the company actually has the right to adjust it, but by no more than plus or minus 0.25% per month.
Okay, so there's a little bit of a buffer built in there.
Right. They are effectively executing a localized arbitrage here. they are taking on a fixed fiat liability, that 11.5% yield, to acquire a scarce digital asset.
An asset that has historically gone up way more than 11% a year.
Exactly. Over its 4-year cycles, Bitcoin's annualized appreciation is significantly higher. So as long as Bitcoin's long-term compounding growth exceeds that 11.5% hurdle rate, the balance sheet grows way faster than the liability.
So they've basically turned themselves into the sole provider of this low volatility, high yield digital credit in the public markets.
That's exactly what they've done.
Which brings up the mechanism of how they actually get these shares out into the market to begin with.
Yeah.
They are using an at-the-market offering or an ATM program.
Right. The ATM program is crucial to understand.
Yeah, for anyone unfamiliar with the term, instead of a traditional secondary offering where a company just dumps millions of shares onto the market all at once.
Which usually just crashes the stock price overnight.
Exactly. Everyone panics.
Yeah.
An ATM program is more like a slow IV drip. They just trickle shares into the open market during regular trading hours at whatever the current market prices are.
They collect the cash.
They immediately buy the Bitcoin.
And then they use the historical appreciation of the asset to justify continuing to pay that dividend.
Right. But that leads to the next really obvious question. Who is actually buying all these shares? Who is supplying all this capital?
That is where the data gets really interesting.
Because looking at the numbers, there is a glaring divide here. Retail investors own a staggering 80% of those stretch preferred shares.
80%. It's massive.
Meanwhile, the institutional buyers, the quote-unquote smart money, they heavily favor the common stock. Why is there such a split?
Well, there is a very specific mathematical reason for that institutional preference. The common stock exhibits an immense volatility profile. It actually has a beta of 3.63 relative to Bitcoin.
Let's translate that for a second. A beta of 3.63. That means for every 1% that Bitcoin moves up or down, this stock violently swings roughly 3.6%.
Exactly. It's essentially Bitcoin on leverage, but without actually having to use Mumchen.
That's wild. So institutions want that wild ride.
They do, because institutions are restricted by their own mandates. A lot of these funds cannot hold raw Bitcoin directly.
Oh, right. Regulatory issues.
Yeah, and they don't want to deal with the custody of digital wallets, cold storage, all of that. So they buy the strategy common stock as the highest beta proxy available in the equity markets.
They just want that amplified momentum exposure.
Precisely. Now, retail investors, on the other hand, they are flocking to the stretch preferred shares.
Because they want the yield.
Exactly. They are attracted to that steady 11.5% payout.
So it kind of sounds like a giant cruise ship. The retail investors are down in the engine room, right, just shoveling coal into the furnace in the form of this yield-seeking capital to keep the ship moving forward.
That's a great analogy.
And meanwhile, the institutional investors are just sitting up on the deck enjoying this highly levered momentum joyride.
Pretty much, yeah.
But what happens if the coal runs out? Like, what happens if retail gets spooked and stops buying?
That right there is the core of the bear case risk. And honestly, it is a severe one.
Because the whole engine relies on it.
Completely. The entire machine relies on being able to constantly issue new stretch shares to buy more Bitcoin. If macroeconomic sentiment remains poor and retail liquidity dries up, that funding flywheel just breaks down.
So the concentration risk is huge.
Massive. You have 80% of the stretch shares held by retail, and they are highly yield dependent. If a severe market crash forces the company to exercise its right to adjust that dividend downward,
Those retail holders could just flee entirely.
right. And if the retail base stops buying, the company's ability to execute its slow IV drip feed completely stalls out.
And we really need to talk about the potential for a market crash, because the current market reality we're analyzing today is it's incredibly bleak.
It's very rough out there right now.
We are looking at fierce macro headwinds. The stock is currently down 19% year to date. And as we mentioned at the top of the show, it is down 71% off its July 2025 highs.
A painful drop for anyone holding from the top.
Plus, the broader macroeconomic picture is not helping either. The S&P 500 and the NASDAQ recently hit 6-month lows. Bitcoin itself has sunk to its lowest level since early March.
Yeah, the macro environment is heavily risk-off.
And there are some really flashing warning signs in the derivative markets, too. Specifically, those leveraged Granite shares exchange-traded funds, they're undergoing reverse splits right now.
Now, that is an incredibly vital signal to unpack for a second.
Why is that so important?
Because a reverse split in a leveraged ETF is almost always a glaring red flag that derivative traders have been completely obliterated.
Wiped out.
Exactly. Leveraged ETFs use daily swaps and derivatives to double or triple the daily return of an asset. But when the underlying asset drops for an extended period, the daily rebalancing causes something called volatility decay.
Volatility decay.
Yeah.
Yeah.
The share price of the ETF literally just gets dragged down to pennies.
And when a stock drops to pennies, the exchange steps in and threatens to delist it, right?
Right. They can't trade under $1 for too long. So to avoid being kicked off the exchange, the fund artificially bundles the shares together.
Like swapping 10 $1 shares for one $10 share.
Exactly. That is a reverse split. It doesn't actually create any value. It's just a life support mechanism to stay listed. Seeing this happen in the digital asset space shows you just how entirely washed out the speculative excess from 2025 really is.
So the tourists are gone.
The tourists are completely gone.
Okay, but on top of those broader warning signs, we also have negative sentiment signals coming from inside the house.
Ah, yes, the insider selling.
Right. A recent filing showed a strategy director actually sold company shares on the dip.
Which never looks good.
It doesn't.
Yeah.
But here's where the messaging gets incredibly tangled. In stark contrast to that director dumping shares, the company itself just bought 141 Bitcoin.
Yep.
And they bought it exactly as the stretch shares returned to their $100 par value. So we have an insider selling shares while the broader market is hitting 6-month lows, yet the corporate entity is simultaneously buying the underlying asset.
It looks like very mixed messaging.
Right. Are they just blindly catching a falling knife here? Like, what is the strategy?
It is so easy to look at that and see a contradiction. But you have to weigh the scale of an individual director's personal portfolio management against the programmatic actions of a corporate treasury.
So you're saying the director selling is just noise?
Largely, yes. The company buying those 141 Bitcoin in this bleak environment is a classic contrarian signal. But the most critical technical detail in what you just outlined, the part investors really need to pay attention to, is that $100 par value of the stretch shares.
Okay, let's talk about par value. Think of par value as basically the baseline price, right? The face value of the preferred share when it's initially issued.
Correct.
And it just recently closed at, what, $99.94? It is hovering dangerously close to that exact line.
Which is exactly why they are acting right now. As long as the market price holds at or above that $100 par value, it acts as a synthetic floor for their financing.
How so?
If the shares trade at, say, $105, the company can issue new shares through their ATM program at a premium, collect the cash, and aggressively accumulate Bitcoin at a deep discount relative to its historical highs.
Oh, I see.
But if the price falls significantly below $100, the math starts working. The ATM machine effectively shuts off because it becomes too dilutive.
So they aren't catching a falling knife at all?
No. They are executing a predetermined algorithmic strategy. They acquire scarce assets whenever their financing floor allows for it.
Wow.
And the fact that they successfully raised over $1.2 billion in March 2026, right in the teeth of a severe crypto bear market, that proves that their access to these deep pools of retail liquidity remains completely intact despite the broader panic.
Okay, so if the speculative excess is totally washed out and this synthetic funding floor is holding strong at $100, what actually triggers the elevator to go back up?
You need a catalyst.
Right. If you were looking at this stock as a value play, what is the spark? We need to look at their structural moat and the imminent catalysts over, say, the next 12 to 18 months.
Let's start with the moat.
Okay. First off, strategy has built an enormous first-mover advantage. From what I'm seeing, these stretch shares are actually beginning to appear as reserve assets on other corporate treasuries.
That fundamental development cannot be overstated. It creates a massive, self-reinforcing network effect.
It's like they're becoming a standard.
They are. Strategy's influence is extending far beyond its own balance sheet now. They are effectively becoming the standard architecture for corporate digital asset finance.
And there's more to it, right?
Yeah. Furthermore, there is growing chatter now, it's unconfirmed at this stage, but chatter that stretch shares could eventually become standardized collateral for crypto-backed loans across the broader financial ecosystem.
Oh, wow. So if I want to take out a loan, I could put up my stretch shares as collateral.
Exactly. And if that truly institutionalizes, it cements Strategy's capital structure into the very plumbing of the market in a way that is virtually impossible for a competitor to replicate now.
That is a massive moat. Which brings us to the timeline of actual events. The catalyst calendar for the next few months is pretty stacked.
It's very busy.
First up is Q1 2026 earnings, which are expected in late April or maybe May. Now, because of strict accounting rules regarding digital assets and Bitcoin's dip in the first quarter, the company is almost certainly going to report severe unrealized losses.
It's unavoidable with the current accounting standards.
Right, so when that earnings report drops, the headline net income numbers are going to look absolutely terrifying to a traditional investor.
Very ugly.
Are you saying people need to just look right past that? Like, do they need to stop looking at this balance sheet like a traditional software profit and loss statement and start looking at it like just a giant corporate crypto wallet?
That is exactly the mental shift that's required here. The traditional metrics of software revenue and quarterly net income, they are essentially irrelevant noise at this point.
Just ignore them.
Pretty much. The true bullish catalyst hidden inside that seemingly terrifying earnings report will be a metric they call Bitcoin yield.
Okay, explain how that works, because normally when I hear the word yield, I think of a cash dividend.
Right. In traditional finance, yes, yield means cash flow. But Strategy uses Bitcoin yield to track the percentage change over time in the ratio of their Bitcoin holdings relative to their assumed diluted shares outstanding.
Let me make sure I'm following. Basically, are they acquiring Bitcoin faster than they are diluting their own shareholders?
Precisely. The company will use that metric to highlight the sheer increase in Bitcoin per share that was facilitated by the stretched share issuance. You really have to look past the paper accounting losses to see the actual physical accretion of the underlying scarce asset on a per-share basis.
Okay, that makes sense. And then we have the second major catalyst, which is the Bitcoin halving anniversary cycle.
Always a huge macro driver.
Yeah. For anyone a little fuzzy on the mechanics of this, a halving is a hard-coded event in Bitcoin software. Every 210,000 blocks, which works out to roughly 4 years, the amount of new Bitcoin created and rewarded to miners is cut exactly in half.
It is a programmed supply shock.
A programmed supply shock, exactly. Now, we had a halving recently, but historically, the price doesn't just explode the day it happens, right?
No, it almost never does. The market is forward-looking, sure, but liquid inventory takes time to drain. When the daily new supply of an asset drops by 50% overnight, it historically takes several months for that supply shock to actually work its way through the exchange order books and meet persistent demand.
So it's a delayed reaction.
Very delayed. This is why the year following a halving is historically when we see the really exponential price appreciation in the asset. And we are squarely in that post-halving window right now.
And tying this back to the stock, if there's a reversal in the underlying asset's price, because of that 3.63 beta we broke down earlier, it would cause an outsized, violently amplified upward move in the common stock.
Exactly. Which perfectly sets the stage for the third catalyst, the actual execution of that $42 billion at-the-market sales program.
The ATM program we talked about.
Right. Remember, they're planning $21 billion via common stock and $21 billion via those stretch shares. Investors really need to watch for SEC effectiveness on those programs.
What happens when they get the green light?
If Strategy can rapidly deploy that capital at these currently depressed Bitcoin prices, it locks in a tremendously low-cost basis. Then, when they post-halving supply shock finally triggers upward price action,
The scaling effects on their balance sheet will just be exponential.
completely exponential.
Okay, so synthesizing all of this data from today's analysis, we've got the perpetual funding engine, the friction between retail yield seekers and institutional momentum traders, the brutal 71% drawdown, and these looming post-halving catalysts. Where does the consensus actually land on this?
Well, looking at the models we're analyzing today, they ultimately give Strategy a bullish score of 8 out of 10.
An 8 out of 10.
Yes, viewing it strictly as a 12 to 18-month value play. Now, it requires a very strong stomach for volatility, but the underlying thesis is solid. Strategy has essentially solved the corporate treasury problem.
They really have.
They invented a perpetual funding vehicle that allows them 247 buying power, completely regardless of the macroeconomic weather. Because the stock is trading at such a steep discount from its previous highs, yet the company is aggressively accumulating assets at that $100 par value floor, it offers incredible asymmetric upside to any recovery in the digital asset cycle.
Assuming the risks don't play out.
Right. The macro headwinds are very real, and the reliance on retail sentiment holding the line is a genuine risk. But their structural innovation provides a highly sustainable moat to just wait out the storm.
It really all comes down to whether that engine room keeps shoveling the coal.
It does.
And brings up a fascinating macro question for you to ponder long after we sign off today. Strategy has proven, literally to the tune of tens of thousands of Bitcoin and billions of dollars in raised capital that a company can invent a perpetual funding vehicle to endlessly acquire a scarce digital asset, completely bypassing traditional debt risk and restrictive bank covenants.
A total paradigm shift.
It is. So will they remain a monopoly in this space, acting as the singular high beta proxy for the entire equity market? Or have they just open-sourced a blueprint that every single Fortune 500 corporate treasury will attempt to copy in the coming decade?
It's the multi-billion-dollar question.
It is definitely something to keep a close eye on as this market cycle unfolds. Thank you for joining us for today's daily stock analysis. Stay curious, watch those catalysts, and keep your wealth strategies smart.